Right, the rate of India's industrial production could slow down over the next couple of months, and that is the indication from the SBI monthly composite index, an indicator for manufacturing activity in the Indian economy. In December, the SBI index has declined to 50.6, showing low growth in the month compared to 51.2 for the month of November. However, the SBI report also says that even though manufacturing momentum may have slowed down, the outlook for some other sectors, particularly fertilizers, appears largely positive. To discuss the fine print of the report, we have with us Soumya Ghosh, Chief Economist at SBI. Soumya, appreciate you joining us here. I know it's time off for you. It's your annual vacation. But very quickly, Soumya, before I get to you on the SBI index, a quick word on the GST numbers. A further decline, 80,808 crores. Your reaction?
The slowdown is actually, there is a slowdown in momentum, and it remains to be seen whether it dips further. So slowdown is actually put strain on the government finances, which already under a little bit of strain. And I think that at this rate, the possibility of a revenue shortfall on the government coffers now looks imminent, even though I agree with the fact that the disinvestment receipts could actually top the budget estimates by around 20 to 25,000 crores.
Okay, so there might be some buffer in the disinvestment receipts, but a revenue shortfall looks imminent is what you're saying. Given that, Soumya, do you believe that 3.2% is likely to hold, or do you believe or anticipate that there could be a minor slippage?
See, I believe that the markets have already factored in. If you look into the bond yields, the way they have been moving now, they touched 7.3% today before retreating to 7.27%. So the way the markets are behaving, I think markets have already factored in a slippage in the fiscal deficit. So I will not be surprised if the deficit goes up to around 3.4 to 3.5%. But my sense is that next 2 days when the numbers for fiscal deficit comes out, that will be very crucial, because I'll be looking very closely at the small saving collection, which at the rate is likely to top 1 lakh across the budgeted number. So if that is the case, in that case, the net market borrowing could actually offer some positive surprise, which could bring down the yield in that case. So my sense is that wait for the 2 days. Let's look at the small saving numbers. If they're good enough, then that will actually have some cushion on the government to finance the fiscal deficit.
All right, so let's wait for the small savings number. But Soumya, let me now ask you about the SBI index. Now, you anticipate a further slowdown in manufacturing. You believe that the IIP number is going to decline further. Why is that?
No, I see that, there are two aspects of this SBI index. One is the year-on-year index, other is the monthly index. If you actually look at the year-on-year index, that looks quite healthy at this point of time. But that is more of a seasonalized number, and that's a statistical fact, because if you look into the numbers for last year, second half, the numbers are actually slowed down. So from that point of view, the year-on-year number could be look at little better. But if you look into the monthly momentum, and which is more crucial, that is likely to slow down, because I think the credit growth as of now for the entire YTD for all scheduled commercial banks is still below 2%, and the prospects of some of the sectors, even though some of the sectors, as I said in the report, like fertilizers look positive, there has been some positive momentum in industries like cement, mining, metal. But overall, I think next couple of months could see some sort of an IIP moderation, given the fact that the resolutions of the accounts, the large accounts, are yet to come in. So in my sense, you have to wait, at least you have to wait for the next couple of months, maybe January, February, before you start seeing some sort of an concrete recovery based on the IIP numbers.
Okay, so let's talk about the sectors that you believe are seeing an uptick. Fertilizer in specific, in FY17, the fertilizer sector has seen an investment of 23,614 crores. Given the fact that this budget one is assuming is likely to be a much more rural, agri-focused budget, that's what the stock markets are betting on. What would your take be in that context then for a sector that's already starting to show promise?
No, I think the fertilizer sector, as I've shown you, there has been more rating upgrades than rating downgrades. I think 5:1 is the ratio. New projects are also coming more into the sector. So I think the fertilizer sector is likely to do much better compared to the other sectors. And if the budget has a rural focus, I think this sector, along with sectors like irrigation, they will also do better. This apart, I think there has also been some renewed interest in some of the sectors within the industry. If you look into the drill down and look into the data, there has been some interest in the sectors like mining, which has been actually showing a positive credit momentum.
Okay.
Then metal is also showing some sort of momentum in anticipation of a resolution. Then there has been also some development in the textiles and gems and jewelry. But all these, I believe, are small green shoots. So that's why I again emphasize that a broad-based recovery will take around 3 to 4 months before that is reflected in the IIP numbers that is released on a monthly basis.
Okay, so just about seeing some green shoots in some sectors, but a broad-based recovery still some time away. Final question, Soumya, where do we close the year in terms of growth?
See, growth, we are still factoring in a GVA growth of 6.4% and a GDP growth of 6.5%, but that there is a big caveat over there. That is on an unchanged base of last year. If the base of last year changes, which is most likely to be released, I think the final numbers will be released in May next year. I think this year's numbers could actually overshoot 6.5%.